Welcome to our today's session of taxation, where we are going to discuss the concept of capital allowances. Capital allowances granted to assets that are repeatedly used in business. Now, before we go into the discussion of these allowances, it is important to understand a bit about the concept of depreciation, which is related to the concept of the capital allowances granted to businesses. Now, capital allowances replaces depreciation, which is not an allowable expense for tax purposes against business income. So it's important to know that depreciation is not an allowable expense against business income, and in its place, capital allowances are granted instead. Capital allowances are granted instead. Now, what is depreciation? It's also important to understand or to remember what depreciation is. Now, depreciation is loss of value of an asset repeatedly used in business. Repeatedly used in business. Now, how is this depreciation calculated? Depreciation is calculated using rates that are determined by the management of businesses. Now that these rates are determined by the management of businesses, it therefore means that these rates are not uniform. And therefore, the depreciation rates have not been standardized or are not uniform across same types of businesses for same types of assets. Now, due to this lack of uniformity, then depreciation is replaced by capital allowances for tax purposes. It is replaced by capital allowances for tax purposes. Now, why is capital allowances replacing depreciation? It is capital allowances replaces depreciation because the capital allowances are computed uniformly for all businesses for same types of assets. So that is important to note, that the capital allowances are computed uniformly for same types of assets and for similar businesses. So that is why the capital allowances, therefore, replaces the depreciation. Very important to note. Now, capital allowances, as per the Income Tax Act, are included in the second schedule to the Income Tax Act. So basically, what we are going to discuss under the capital allowances in this session is borrowed from the second schedule to the Income Tax Act in Kenya. Second schedule to the Income Tax Act in Kenya. Now, of importance to know is that capital allowances reduce the taxable income in accordance to the Income Tax Act in Kenya. They are an allowable expense against business income, which results in a reduction in the tax payable. So that is the key thing to understand here, that capital allowances reduces the taxable business income in accordance to the Income Tax Act in Kenya. In accordance to the Income Tax in Kenya. Now, they are granted for various reasons, which are also very important to note, that why are these capital allowances granted? So they are granted for various reasons, and amongst them are the following reasons. One is as an allowance for loss of value of assets, that is fixed assets repeatedly used in business. Remember, when assets are being used in business to assist the business in generation of taxable income, those assets loses value. Now, the Income Tax Act, therefore, says that an allowance should be given for this loss of value. Remember, again, the businesses, after some times, may require to replace the assets that are losing value over time. So the businesses, by giving this allowance to the businesses against the taxable income, it means the businesses can be able to set aside a certain amount of money before tax, which can be used to replace the asset in the future. That can be used to replace the asset in the future. Now, the second thing is that it is an incentive to encourage development of industries. As an incentive to encourage development of industries, e.g. the manufacturing industries, the tourism industries, and mining industries. So an incentive. The third key thing is as an incentive to encourage development of industries outside the main urban centers. Outside the main urban centers of the major urban centers of Nairobi, Kisumu, Mombasa, Nakuru, like that. So remember, decongestion of industries is important. So to have industries set outside the main urban centers, what the income tax does is it gives enhanced rates of capital allowances to encourage the development of these industries outside the main urban centers. So these rates can be as high as 150% of the qualifying cost of the investment incurred outside the main urban centers. Now, the fourth thing is as an incentive to encourage exportation, hence the generation of foreign exchange currency. Hence, generation of foreign exchange currency. Now, this occurs through manufacture and abroad. This is manufacturing purposefully for exports. So the businesses that manufacture purposefully again for export, they would get favorable rates of capital allowances. Remember, when we have businesses manufacturing specifically for exports and these exports go outside Kenya, this brings in foreign currency. And this foreign currency is very important in our country because it bridges the gap of the imbalance of payment. So these are the businesses then that will manufacture for export purposes only. They will be granted enhanced rates of capital allowances. So basically, the capital allowances are given as an allowance against the loss of value of assets repeatedly used in business, and mainly as an incentive to encourage businesses. Now, once we know that, then it's important to know the types of capital allowances that are granted as per the Income Tax Act, second schedule. Now, the first one is the wear and tear allowance. Normally, we abbreviate it as WTA, the wear and tear allowance, WTA. The second type of allowance is industrial building allowance, also abbreviated as IBA. As you can hear here, it is related to buildings and structures, industrial building allowance. The third type of allowance is investment deduction, abbreviated as ID, from investment deduction. Under the investment deduction, we have investment deduction for normal manufacturers. And then we have investment deduction for boarded manufacturers. And then we also have the shipping investment allowance. So these are under investment deduction, ID abbreviated. Then the fourth type of capital allowances is the farm works deductions, FWD abbreviated, farm works deductions, basically granted to businesses engaged in farming activities. Then we have also mining allowances. The mining allowances are granted to the businesses engaged in mining operations, So basically, those are the types of capital allowances that we have: the wear and tear allowance, WTA, the industrial building allowance. We have the investment deduction for normal manufacturers. Then for boarded manufacturers, we have the shipping investment deduction. We have the farm work deductions, and we have the mining allowances. So under these listings, we can take the first type of the allowance, which we have mentioned, we have called the wear and tear allowance, abbreviated as WTA. Now, the wear and tear allowance is granted as an allowance for loss of value of assets reputedly used in business, just like we had said before. It is granted instead of depreciation, as I have explained again before. It is granted instead of depreciation. Wear and tear allowance is computed uniformly. Very important to note, it's computed uniformly for all the taxpayers, and is computed on a reducing balance basis. So uniformly for the taxpayers and computed on a reducing balance basis. And assets are normally classified as follows for the purpose of the wear and tear allowance. So we have classes of assets for this purpose of wear and tear allowance. Now, class number 1. Class 1 is granted wear and tear at the rate of 37.5%. This class includes heavy earth-moving equipments. Heavy earth-moving equipments, such as tractors, lorries of 3 tons and above, lorries of 3 tons and above, caterpillars, tippers, bulldozers, trailer, engine hand, mobile forklift, loaders, trucks, combined harvesters, mobile cranes, buses, engine hand of a train, etc. The key thing here is every other moving equipment, and we are looking at 3 tons and above. So in case we have something like a delivery fan, which is 3 tons and above, then it will also come to this class. Then we have the second class is 30%. The wear and tear is granted at the rate of 30%. Now this class includes office electronic equipments, such as computers, computer hardware. So computer hardware, we have photocopiers, we have duplicating machine, we have the scanners, we have the printers, the ETL machine, we have electronic calculators, etc. So these are the includes office electronic equipment. So these are the equipments necessary for the proper operation of the office. So electronic equipments necessary for the proper operation of the office. Then we have the third class, class 3. The wear and tear is granted at the rate of 25%. Now this class includes other light self-propelling machinery, e.g. lorries below 3 tons. Remember here we had put lorries above 3 tons in class 1. So here you bring lorries below 3 tons. Even delivery vans below 3 tons will be here. Then we have saloon cars. We have pickups. We have delivery vans. These are the delivery vans again of 3 tons and below. If the delivery van is 3 tons and above, then it will come to class 1. We have aircrafts. Then we have tuk-tuks, etc. So those ones will belong to class 2. And the rate of wear and tear allowance is at 25%. Then we have class 4. The rate of wear and tear allowance is 12.5%. It includes all other assets necessary for proper operation of business. So all other assets now for proper operation of business, such as furniture and fittings. We have typewriters, basically the manual typewriters. We have the immobile forklifts, fixed ones, in other words, fixed. We have bicycles. We have refrigerators there, air conditioners, telephones, both fixed and mobile. We have switchboard, carpets, curtains. We have shredder, plows, wheelbarrows, milking machine, train coaches, cameras, processing and manufacturing machinery, conveyor belts, sorters, lawn mower. We have the weighing machine, push carts. We have the cash registers, the generators, and water pump. We have the ship, traders, alarm systems, the neon sign, surveillance cameras, manual calculators, etc. So these assets are many. So class 4 mainly consists of the very many other assets that are used in business for the proper operation of the business and are not in class 2 are not in class 1, class 2, or class 3. Then, after knowing now the classes of these assets, the classes for wear and tear allowances, then the next important thing to know is the schedule of wear and tear allowance. How do we compute generally the wear and tear allowance? The wear and tear allowance are computed using a schedule. In this schedule, we use the 4 columns. We use the 4 columns, each for each class, one for each class. So we show the classes and then the percentages for granting the wear and tear allowance. Now, in this schedule, the first thing that is indicated or included is the opening balances for the schedules. The opening balances for the schedules. Now, these opening balances in taxation are known as the tax written down values. The tax written down values brought forward. Now, if it is the first year of operation of a business, we shall not have the tax written down values if it is the first year of operation of a business. But if it's the second or the subsequent year of operation of a business, then we shall have the tax written down values brought forward. So for a business which is starting the first year, which has not been in operation previously, we shall not have the tax written down values, but instead we will start from the additions. So we have the tax written down values brought forward at the start of the year. Then we bring in the additions during the year. Additions during the year. What are these additions? These are the assets that have been bought during the year. So the additions are the costs of the assets that have been acquired during the year. So the additions mainly include the qualifying cost. So you don't only put the cost, but we put the qualifying costs. Qualifying for what? The cost qualifying for the wear and tear allowance. For the wear and tear allowance. We will go into more details about how to determine the qualifying cost for some specific cases. But in most of the cases, the qualifying cost is the purchase cost of the asset. Then we have the disposals. So during the year, it is normal for businesses to also sell some assets for one reason or the other. So in this schedule, we also include the disposals during the year. So the amounts to deduct here again are the qualifying values of disposals. We'll also look at the qualifying disposals for some specific cases. But in most of the cases, it is the sales proceeds. In most of the cases, it is the sales proceeds that we get when an asset is sold or disposed. So after that, then, we shall net off, or we shall get the total. So we get the tax written down value, we put the additions, and then we remove the disposals. We'll get the total. That is us at the end of the year. So that will be done for each of the classes. And then on this total, we shall apply the percentages. So like in the first class, it will be 37.5% of our total here. That figure is the one we have put here, and it will be described as the wear and tear allowance. So it is the percentage here applied on the total of each column. And that is what will be the wear and tear allowance. So that one will be done for all the classes, and we shall deduct this wear and tear allowance from our total here. And what we shall get is now the tax written down value to be carried forward. Carried forward to the subsequent year. So it is being carried forward to the subsequent year. So this will be at the end of the year. For instance, 31st December 2014. It will be the opening figure on 1st January 2015. So we are carrying it forward to the subsequent year, the first day of the subsequent year, meaning closing figure at the end of the year, that is 31st December, becomes the opening figure at the beginning of the subsequent figure. So we are carrying it forward to the subsequent year. So this schedule of the wear and tear allowance, once we begin granting the wear and tear allowances, the schedule continues in subsequent years. So the same schedule now continues. What we shall be bringing in is additions and disposals. We get the total, we give the wear and tear allowance. And it continues throughout the life of a business. So that schedule will continue throughout the life of a business. Now, once we have known now the general schedule of computing the wear and tear allowance, I'll give one note, and this note regards the computer software. The computer software also enjoys the wear and tear allowance. It enjoys the wear and tear allowance. So here is the computer software. The computer software. Now the computer software qualifies for wear and tear allowance at the rate of 20% per annum on a straight line basis. So rate of WTA is 20% per annum on a straight line basis. So this is a straight line basis. So we are separating the computer software from the hardware. The hardware we've put in class 2, and it is enjoying the wear and tear allowance at the rate of 30%. The software we have put in its separate class, where it is enjoying wear and tear allowance at the rate of 20% per annum on the straight line basis. Now, why are we giving it at 20% and then on a straight line basis? The assumption here is that most of the computer softwares do not last for more than 5 years. That is, their useful life 100 goes beyond 5 years. The reason being that due to changes in technologies, softwares can become obsolete within the first 5 years of use. So this is basically due to obsolescence or change in technology. And that's why we are giving 20% per annum straight line. As in, within 5 years, we may need to replace the computer software in the businesses. So that is why it is not on a reducing balance basis, but it is on a straight line basis. Now, another type of capital allowance is, wear and tear allowance is the diminution in value. So I'll also add another one called diminution in value. So diminution in value. Now, on when does this apply? The diminution in value. Now, diminution in value is granted at the rate of 1/3, 1/3 of the cost per annum. So the rate is 33 1/3%, or just 1/3 per annum. This is again on a straight line basis. So the diminution value is 33 1/3%, or 1/3 per annum on the qualifying costs. Now, which assets enjoys what we are calling the diminution in value? This is granted to small items small items or assets which do not fit in any of these classes. So they don't fit in class 1, they don't fit in class 2, they don't fit in class 4, they don't fit in class 3, and they are not computer software. So it's granted to small items or assets which do not fit in any class of WTA, that is the word tier. And it is granted at the rate of paid year 33 and 30% or a third per annum on qualifying cost. On qualifying cost. And it is granted on a straight line basis on loose tools. Loose tools. So basically the assets that qualify on this are loose tools. Loose tools and equipments. Loose tools and equipments. Utensils. Library books with a lifespan of more than 1 year.